Hello and welcome back to Game of Trades, your #1 channel for videos on the stock market and cryptocurrencies. The S&P 500 is testing its 200-week moving average. In fact, it bounced off the 200-week moving average, and we've had quite a nice rally, small rally, but a nice rally nonetheless off that level. Now, let me remind you exactly what this is. This is the secular bull run moving average. It has defined bull runs throughout the last 40 years, right? Ever since 1982, the stock market has bounced off the 200-week moving average systematically when confirming the secular uptrend. And in fact, the previous secular bull run from the 1940s all the way to 1968, that's what I define as the previous secular bull run, also used the 200-week moving average as a major level of support. And then in 1970, 1974, of course, that support level was broken. Many investors are of the opinion that the massive interest rate shock that we've had in 2022, and this is a chart we've shown a couple of times on this channel, the Federal Reserve has created a rate shock unlike anything we've seen throughout history except for 1981 when Paul Volcker was the chair of the Federal Reserve. And so many investors are of the opinion that this rate shock is going to lead to another big breakdown of this secular uptrend, right? Similar to the big four. I call these crashes, right? 1970, 1973, 2000 to 2003, 2007 and 2008. For me, those are really the four instances where price broke down the secular uptrend and stayed down for multiple years before eventually recovering and taking, again, multiple years before really recovering those losses. That is what we want to avoid. That's what most people want to avoid. And, you can understand why there's a lot of concern around that, given the extreme developments we're seeing in today's macro environment. Now, everybody knows that at one point it is going to end. At one point, you're going to see something break in the system. There's going to be a big recession, and that's going to trigger a large bear market, right? Everybody knows that. A recession always eventually comes. The question is when? And that can be a very painful question, because I can tell you a lot of people have been calling for recessions throughout this period, and this correction is really no different to some of the other corrections that we've seen back to the 200-week moving average. This is why the market comes back to test this secular moving average. It's because it's having a doubt. Investors are doubtful of whether or not it's going to continue, and this is one of those moments, which brings us to the question, is this just another bear market rally before we really start to get into the meat of the bear market, break down the secular bull run moving average and get into this type of move and join the big four for it to become the big five, essentially? If you're interested in following these crazy markets with us, don't forget to smash that subscribe button. We make these videos multiple times a week covering everything on the market, the macro, technicals, internals. We try to educate, inform, and help our viewers as much as humanly possible. And of course, if you enjoy this video, make sure to smash that like button as hard as you can. And now, without further ado, let's get right into it. Now, the first chart I want to show you guys and discuss in this video is the market breadth. It's absolutely essential to look at market breadth when you're looking at the S&P 500. The S&P 500 isn't just one stock, it's a whole basket of stocks. And so breadth looks at how these stocks are behaving, whether there's a large portion of those stocks that are participating, breadth is going up, or whether most of those stocks are going down, breadth is going down. And so this indicator can be used in a variety of different ways, but one of the very interesting ways to use it is as an oversold indicator. Now you can see here, let me put up the S&P 500, and you can see very quickly every time that we get to the levels where we've currently been at, right, which is around the 17% mark. So that means 17% of stocks within the S&P 500 are trading above their 200-day moving average. So vast majority of stocks are trending down. You can see we've had that throughout 2022. We had that reading right here in COVID at the bottom of the COVID crash in 2018, at the bottom of the 2018 crash. 2015, 2016, 2011, of course, in this 2009 bottoming pattern. So looking out 6 to 12 months, a lot of these are extremely attractive buying opportunities, right? Looking out 6 to 12 months. And I can show you an example of a moment where we hit that line here, right? And I can put that line a little bit lower if you want to make it really more similar to where we are today here. You can see in this case in 2008, this reading got triggered really right here at the bottom, right after the waterfall sell-off of 2008. Now you can see looking back, this was a good opportunity, and we've talked about this before, but in the short term, this was November of 2008 or October of 2008, and the bottom didn't really occur until March of 2009, right? So those were a few very difficult months for anybody who was using this indicator as an oversold reading for the market. But nonetheless, that's what this chart is showing, right? And that's the way we're looking at this. We'd like to use breadth as an oversold indicator, but there is a flip side to this. There is always the other side of the coin. First of all, this doesn't go back very far. It only goes back to 2007, so there's a big bias that the majority of this data is actually during a bull run, right? So that's a first bias. And then secondly, you can see we actually had a pretty oversold reading right here in February of 2008, right? And so if we put the cutoff a little bit higher here, not a lot higher, right? A little bit higher than what we saw here in June and October of 2022, this was an oversold reading similar to 2011, similar to all of these big bottoms, but this was an incredibly bad moment to be buying stock. And that's pretty much regardless of the time frame. The forward returns from that moment on were poor. You lost around 50% of your investment in the next 1 to 2 years. And it wasn't until around 2013 that you really started to make a profit on your investment without accounting for inflation. Right, so that's 2008 to 2013, 5 years being underwater on your investment. That's definitely something you want to avoid. So that's something to take into account, right? But at the end of the day, right, you're going to have to take a bet somewhere. Nobody has the crystal ball. Nobody is going to be able to guarantee you returns. And so you have to make a bet from a macro standpoint, whether this correction is a buy the dip opportunity similar in size and magnitude to the one we had in 2011, 2015, 2018, 2020, or is this really a pre-2008 period? And we're going to discuss that in just a minute. But if you are so far enjoying this video, don't forget to take a couple of seconds to hit that gray thumb down below as hard as you can. It really helps push out our videos to more people. It is really appreciated. And also, if you haven't had the chance to check out our new website, it is launched with all the cool features that we've been working on that'll make your life easier as an investor. And we have the first free feature on our website. That's the quarterly newsletter. Of course, that's going to be updated once a quarter. We've tried to make it a pleasure to read. There's some beautiful charts in there, some very relevant information that hopefully adds to the public debate on the internet. So go ahead and check it out. And if you like it, make sure to share it on social media. So check it out by clicking on the link down below. And if you like it, don't forget to share it on social media. So the macro bet, whether or not this is 2008, whether or not we're going to have a financial crisis, we could definitely have a financial crisis. Again, the tightening that we've seen today is very impressive, and we think that's going to have some impact down the road. But again, that's a question for another day. Tightening doesn't really materialize until a year, maybe a year and a half, maybe even 2 years later. So unless the economy is extremely, extremely fragile and the consumer is extremely leveraged, perhaps we're not actually going to feel any of this until later in 2023. And one of the charts that I think is important to take a look at in an objective manner, and that is the household rate sensitivity, household credit to GDP ratio. Since 1948, now obviously we had a massive leveraging up of the household between 1948 and 2008 with a credit bubble, right? This was a bubble, household credit bubble between 2000 and 2007, created a devastating financial crisis. But since then, we've been deleveraging, at least households have been deleveraging, meaning it's less likely that we're going to see this type of full-blown panic like we saw during the global financial crisis, where household credit was extremely elevated compared to the actual economic output. It's a different situation. So perhaps those doom and gloomers that are out there are underestimating how much deleveraging we've actually seen since the financial crisis. And we can also see that high-risk borrowers, right, high-risk borrowers that essentially drove the financial crisis, right? It was a massive widespread default on mortgages. You can see those high-risk borrowers on mortgages were leveraging up into the financial crisis. And that's definitely not the same thing that we see today, whether we look at mortgage or non-mortgage high-risk borrowers. There's just less of them than over the last 20 years. Now, in the very near term, you've got a nice rally here. Powerful stuff right there. Now, of course, in the short term, it's influenced by, what the Fed says, individual economic numbers. Now, in the short term, price action can be incredibly difficult to time. We did have a nice bullish setup here that we highlighted a few times on this channel. Price was moving down here, right? Momentum was not confirming that move down. You can see here, momentum clearly confirming that move down on the S&P 500. And here on this move down, not so much, right? RSI is moving higher, telling you you're probably going to get a counter trend move. And we had a similar thing happen right there. Momentum confirming that move down, but here, not so much. RSI moving higher. So I think this could have legs, right? If you take a look at the weekly chart, we also have some amazing divergences here. You can see clear lower low on the price. Price is coming down to the 200-week moving average, and you've got a higher low on the RSI. That is pretty compelling. It's a beautiful setup. So I think the market here is setting up not for a collapse, but for a recovery, for a large recovery of this low. Now, in the short term, could we see a retest, right? Extend these divergences like this? It's entirely possible. Why do I say that's possible, despite the fact that there's these bullish technicals both on the daily and weekly time frame? Because you do have the bond market still not quite convinced that the market environment is shifting. The 10-year yield still moving down, and that's really been a driving force pulling down the market throughout 2022. So this is something we need to respect and make us a little bit more cautious of what's going on here. That's why I'm not taking too much of a stance in the short term, because while the technicals are bullish and suggest we should be coming in to, at the very least, this trend line in the near term, bond market is not quite agreeing with that. So that's something else that we'll be watching very closely on gameoftrades.net through the S&P 500 updates. Now, that's about all I wanted to cover in this episode. I hope you guys enjoyed. If you did, don't forget to smash that like button and subscribe to the channel if you haven't already. Now, in the meantime, I wish you good luck on your trading and see you next time.